one of the most important topics is zero DTE. Everybody's talking about it, right? Obviously, a panel here at RMC covering it was one of the funniest and best actual group of guys. Two people I've gotten to know quite well over the years, Dennis Davitt from Millman and Ewan Sinclair from Hull Tactical here to join us to talk about some of the new things going on and opportunities in zero DTE. You and I, in the panel, you had talked at some point about some of the overvaluation that happens overnight in zero DTE. I'd love to hear from both of you guys what some of the best opportunities that you see in zero DTE and how you trade it.
Okay, I don't really want to get too deep into how I trade it because, that's sort of might be a little secret sauce.
Fair.
But I think the great thing about zero DTEs and short-dated options in general is they give you access to an entirely different variance premium. There's a term structure variance premium, and a one-day option is a very different beast to a 30-day option. You're trading something with a totally different exposure. And so that's, to me, that's it. It's not that they are intrinsically special on their own. They are just an instrument that gives you exposure to another risk premium. And you may think they're highly correlated, but it's not as high as you'd think. So that's really all I see them as. And I think the overnight thing's interesting because generally there is more premium in these options when the market's closed because people are scared of something happening when they can't do anything.
Yeah, that's fair. Dennis, what about you? How I know you guys don't use zero DTE a ton, but what are you seeing in terms of who's trading zero DTE, how it fits in the broad micro structure of markets?
The funny, the panel was about hedging, and it turned out to be a lot about 0 days to expiry options. Full disclosure, I don't traffic in 0 days to expiry options. My focus is a lot different in the funds that we run for institutions. But trading options for 35 years, I have traded a lot of options with 1 day till expiration. I actually have a different approach when I used to trade those, and I just looked at it as a pure premium. Like, too many times in options, and people get misguided on this, where they look at the hockey stick charts of break-even analysis, and they don't realize that, if there's 6 months left in an option, it has time value in it. 0 days expiry options are the hockey sticks. So I don't like putting them into a risk management tool. I tend to look at them from a break-even point of view. So fundamentally, if you're in a fundamental analysis of a stock or an index, 0 days to expiry are pretty interesting tools to use because you're making a strong opinion based on the premium that's embedded in that option. I don't look at it as Vega. I mean, we used to normalize Vega. I don't know how you normalize Vega in a 1 day option. I mean, it's tough to normalize Vega looking at a 2-year option relative to a 2-month option. I don't know, a 2-month option to a 1 day option. I don't know. I'm getting too old for that.
There is a couple of ETFs that are starting to use zero DTE. There's a call writing ETF, that was brought up at another panel. A lot of selling more than anything, some directional trading as well. I think those are the two more most common things I'm hearing. Do you see particular kinds of trades that come into the market? What is the current lay of the land in terms of different trades in zero DTE?
In terms of the trades we're seeing, retail are being very heavily handicapped by their brokers, which is good. So there's a lot of selling of call spreads, selling of put spreads. They're very rarely naked short. They're just not allowed to be. So that's what retail's doing, basically legging into either one side or an iron condor. A bit of a problem with that as well, but we probably get to that a bit later. So the market makers are often getting along the wings, like the 15 deltas, right, because that's where the retails that's their short strike. Right. The implied curve is a little bit distorted relative to longer dated ones because of that.
I mentioned on our panel, but no one talks about, there has been a huge multi-billion-dollar increase in yielding ETFs. I don't know if Jeppy is one of them, right? He's been fabulously successful, $30 billion. The structure of that is he is short calls, so the street is long calls, rolling off every day, hundreds of millions of dollars. So that's a natural fit for these zero DTE. Because if you're the bank, and we're seeing retail buying a lot of these sort of options, or maybe they sell some of them, I don't know, you have the natural other side of that. And that's part of the larger solution of like, are these exotic and are these like crazy? And no, they're successful because there's supply out there and there's getting in between them can be profitable.
I think it's amazing, right, how far it's come in the last 10, 15 years that now we're talking about zero DTE being almost 50% of the flow, right? I think that speaks to those network effects that allow the offset of risk and all the different players. That said, it's still the end of the distribution, right? And there's more risk as you get further away from the center. And
what do you mean?
Well, you can't lay off a lot of the risk that you would if I trade a 1 month option. I can trade a 3-week option against it. I can trade a 5-week option against it. If I trade something 5% out of the money, I can trade something 4% of the money and 6% of the money against it.
But a zero DTE, if you're on the other side of that large funds flow and there's people in there buying and you have something with 2 days to go, this is a natural fit.
For me, it's more like it becomes a closed system. Actually, last RMC, we had 2 market makers on stage and there was a question posed. And the question was, how the heck do you hedge your zero DTE? And unanimously, both of them said, only with other zero DTE. Now, the reasoning was they moved too fast. It's so difficult to hedge out the convexity embedded in that. So it's a bit of a closed system. So when you start talking about liquidity,
but I don't see convexity in these. I think these are highly gamma centric options. The deltas go to 100 very quickly, and then they're done. Right?
That's how far out of the money.
But that sort of is convexity, though, isn't it? I mean, you're flipping with 0 to 100.
I view convexity if you have something, an option, real convexity. I see something, an option with like 2 weeks to go, and if you have multiple contracts on versus 15-to-1 underlying versus options, I just the ability to hedge them is there. They go away at the end of the day. And if they're doing zero DTE to zero DTE options, that's one market maker's approach. I don't know if I would agree with that.
Obviously, the benefit of this relative to a 2-day or a month option is it goes away at the end of the day.
Well,
completely agree with you in terms of those risks.
I mean, there's plenty of equity zero DTEs. Like the ETFs are huge.
Correct.
One of the problems with hedging the SPX options with the underlying is at the end of the day, you've got to do something with the underlying. Mm-hmm. And because the delta changes so quickly during the day, you've got to do something with the underlying all day, and the edge in dollar terms is small. You can easily eat up all of that with 3 or 4 hedges. So having a static hedge is really, it's just cheaper.
Right.
Can't you just put it in the chat GPT and say, hedge my zero DCE options?
Convexity aside, though, I think of it almost like a GME situation, right?
I think they're really neat instruments, and I think people can use them and use them well. And there's been so many people that are saying they're going to be the end of options trading as we know it. And then there's other people that are like, it's the greatest thing since sliced bread.
I want to be 100% clear. I think they're great instruments. I think they allow for realized positioning without some of the complexity of the implied. They are clean and pure in what they provide for investors. And I think that's part of why they're so popular. So I want to be clear. I think they're great products. Just like anything, come with risks, and understanding those risks, I think, are important.
Well, I think it's worse in that regard because things can get so quickly out of control. The sort of thing that you need to know in a 1-year option, you've got months to think about these things. So even going back to the how do you hedge it, right? Uh-huh. Is a good hedge the 1 DTE? Well, no. And we know clearly why it isn't, right? Because at the end of the day, you don't have a hedge position anymore. But I've seen plenty of traders get into trouble hedging a 3-year option with a 2-year option. And they're like, well, it's a hedge. Yeah, it is now. But sooner or later, one of them is going to be a 1-month option and one of them is going to be a 13-month option. Right? Mm-hmm. And then you're going to be complaining that you can't get out.
Yeah. And so back to the normalization of vol, right? Going back to the mid-90s, that was real forward thinking of every option at the money is the same Vega, and then you had positive and negative reverting vol on top of it. And I don't know how I would fit that in a model with a 1 day. It'd be like a negative billion Vega.
Well, see, some of this is like, we now have a lot more high frequency data. Right. And, in the old days, it was all daily stuff. And so to get your vol betas. You're using daily implieds and stuff. Whereas now you can actually put together a lot of data points and come up with, you still have all the problems, but you can come up with a better answer than you could have if you were only using daily data. So I think that goes along with the zero DTE complex as well. The fact we have a lot more high frequency data, and like our zero DTE vol model is based on 1 minute returns. And you couldn't have done that 20 years ago. They didn't,
6 minute abs.
Never a dull conversation. Thanks, guys. Appreciate you joining me.
Sure thing.
Thank you.